Intro to TVM. Why time is literally money. John is standing in his factory, and for the first time, things are looking stable. The Stickman keyboard brand is a success. But today, he isn't looking at a blueprint or a soldering iron. He's looking at two different envelopes. In his left hand is an envelope containing a check for $10,000, payable immediately. In his right hand is a contract for a bulk order that promises to pay him $11,000, but only if he waits exactly 1 year to collect the money. On the surface, the $11,000 looks like the better deal. After all, 11 is bigger than 10. But as John is about to learn, in the world of finance, you can never compare two sums of money without first considering the time value of money, TVM. As Brealey, Myers, and Marcus emphasize, a dollar today is worth more than a dollar tomorrow because of the interest that dollar can earn. To understand this, John needs to stop thinking about money as a static object and start thinking about it as a seed. If John takes the $10,000 today and puts it into a safe investment, say a bank account or a government bond earning 12% interest, that money will grow. By the time the year is over, his $10,000 will have earned $1,200 in interest, leaving him with $11,200. Suddenly, that $11,000 offer doesn't look so generous. By taking the larger sum later, John would actually be losing $200 in potential value. This is the opportunity cost of capital. Every time John chooses to wait for money, he is paying a price. The profit he could have made if he had that money in hand today to invest or expand his business. The time value of money isn't just a theory. It's a physical reality of the economy. Think of interest as the rental price of money. If John wants to use someone else's money to buy a new 3D printer today, he has to pay them interest for the privilege. Conversely, if a customer wants to keep John's money for a year by delaying payment, they should have to pay him for that privilege. This relationship between time and value is what allows us to bridge the gap between the present and the future. We use the interest rate as a translation device. It allows John to convert future dollars into today's dollars so he can make an apples-to-apples comparison. Without this tool, John would be flying blind, unable to tell if a long-term contract is a golden opportunity or a financial trap. Let's look at the basic math that John uses to solve his envelope dilemma. To find out what his $10,000 is worth in 1 year, he uses the future value formula. He takes his initial investment, which we call the present value, PV, and multiplies it by 1 plus R, where R is the interest rate. In our example, $10,000 times 1.12 equals $11,200. This calculation shows the compounding effect of just 1 year. It tells John exactly what he is giving up if he chooses to wait. This is the foundational logic of every bank, every stock market, and every retirement fund on the planet. They all operate on the principle that time has a cost, and that cost is measured in interest. But TVM is about more than just earning interest in a bank. It's about the reality of risk and consumption. A dollar today is certain, while a dollar promised in a year is a maybe. The person who promised John $11,000 could go out of business, or they might simply forget. Furthermore, if John has the money today, he can buy supplies, pay his workers, or even buy a pizza. If he waits a year, he gives up that immediate utility. Therefore, the interest rate John uses to evaluate his options must reflect not just the bank's rate, but the risk he is taking and the urgency of his needs. In the world of corporate finance, we call this the discount rate. It is the hurdle that any future payment must clear to be worth the wait. As John sits at his desk, he realizes that mastering the time value of money changes how he views his entire business. He no longer sees a profitable contract as just a high number on a piece of paper. He asks, when does the cash arrive? And what could I do with that cash in the meantime? He begins to value cash flow over accounting profit. He understands that a business that gets paid quickly is fundamentally more valuable than a business that gets paid slowly, even if their total sales numbers are identical. This insight is what allows him to negotiate better terms with suppliers and customers, ensuring that the Stickman engine isn't just running, but is accelerating at the most efficient pace possible. Ultimately, The time value of money is the universal language of finance. Whether John is valuing a small keyboard order or a multi-million-dollar factory expansion, the logic remains the same. He must always discount the future and compound the present to find the truth. By choosing the $10,000 today and investing it, John isn't just being greedy, he is being rational. He is ensuring that his wealth is working for him every second of every day. As he puts the $11,000 contract aside and picks up the $10,000 check, John isn't just taking the money, he's taking control of his time. He's ready to move into the deeper math of compounding and discounting, armed with the knowledge that in the world of finance, a clock is just a specialized type of calculator.